Imagine you're sitting at your kitchen table, coffee's getting cold, you're staring at your credit card statement, $15,000 at 18% interest. Your minimum payment just jumped to $450 a month. That's groceries. That's the car payment. And here's the thing, you didn't even buy anything new this month. You just rolled over last month's balance at a higher rate. The debt didn't grow because you overspent. It grew because the math changed. Now zoom out. Stop imagining you're a person. Imagine you're the United States Treasury. It's 2026. You're not refinancing $15,000. You're refinancing $16 trillion. And you're not doing it over years. You're doing it in 24 months. The experts tell you not to worry. America has borrowed before. We've always paid our bills. We're the safest investment on earth. But there's a number buried in the Treasury's own data that changes everything. A number that makes this the year the global economy hits a mathematical wall. Because when the interest you pay exceeds the speed at which you grow, the debt doesn't just increase, it accelerates. And once that engine starts, there's no gentle way to stop it. 9 weeks into fiscal year 2026, the United States Treasury has already paid $104 billion in interest on the national debt. That's $11 billion every single week. To put that in perspective, $11 billion is more than the entire annual economic output of Iceland. And this is just the beginning. By the time this year ends, interest payments will exceed $1 trillion for the first time in American history. That's 15% of all federal spending. More than Medicare, more than defense spending, more than veterans' benefits combined. The experts tell us not to worry. The International Monetary Fund projects US GDP growth of 2.0% in 2025, slowing to 1.7% in 2026. The Treasury Secretary assures markets that America's debt is manageable. The Congressional Budget Office's baseline assumes everything stays stable. Global debt sits at $323 trillion, 235% of world GDP, up from $251 trillion just a year ago. But debt has been high before, they say. After World War II, US debt reached 106% of GDP, and the economy recovered. Japan carries debt at 230% of GDP and hasn't collapsed. We've always found a way. But buried in the Treasury Department's own data is a number that changes everything. $9.2 trillion. That's how much US government debt matures in 2025, roughly 1/3 of all outstanding marketable debt, nearly 30% of US GDP. Add the $1.9 trillion deficit, and the government must sell more than $10 trillion in securities this year, a volume no modern market has absorbed before, and in 2026, another $7.6 trillion comes due. Here's what the mainstream narrative won't tell you. Over half of US debt held by the public, more than $14 trillion, will mature in the next 3 years. When this debt was issued, the average interest rate was 3.27%. Now it must be refinanced at rates between 3.75 and 5.25%. The numbers are brutal. That's an additional $300 billion in annual interest costs just from refinancing existing debt at higher rates before adding a single dollar of new borrowing. This isn't a political problem. It's not about spending priorities or tax policy. It's about a fundamental reality. When the interest rate you pay on debt exceeds the rate at which your economy grows, you enter what economists call the snowball zone. Your debt doesn't just grow, it accelerates. Compounding takes over, and once you cross that threshold with debt already at 100% of GDP, there's no gentle way back. For the first time since the 2008 financial crisis, that threshold has been crossed. The US government's average borrowing cost is rising, while economic growth is slowing to 1.4 to 1.8%. The Penn-Wharton budget model calculates the maximum sustainable debt to GDP ratio at 200% under the most favorable assumptions. More realistically, 175%. But here's the critical number. The flipping point, where debt dynamics become irreversible without drastic intervention, is 106% of GDP. The US debt to GDP ratio was 100% in 2025. The Congressional Budget Office projects it will hit 107% by 2029, exceeding the post-World War II record. And that's if nothing goes wrong. This isn't a crisis that's coming. By the time 2026 ends, the US Treasury will have refinanced over $16 trillion in debt in just 2 years. The wall isn't theoretical, it's already here. Between 2020 and 2023, the US government borrowed heavily at historically low rates. Pandemic stimulus, infrastructure spending, and emergency aid pushed borrowing to unprecedented levels. But there was a decision made in those years that set up today's crisis. The Treasury relied heavily on short-term bills, Treasury securities maturing in 1 year or less, to fund the government. It seemed prudent at the time. Short-term rates were near zero. Long-term rates were barely above 1%. Why lock in 30-year bonds when you could borrow for 6 months at virtually no cost? Today, T-bills maturing in a year or less make up 21% of all outstanding debt, up from 15% in 2021. That's over $7 trillion in debt that turns over every 12 months. The weighted average maturity sits at 72 months, close to a 3-decade high. But that's misleading, because 1/3 of all debt rolls over annually. This means the US government must return to markets every week, selling $694 billion in securities in a single week in November 2025, for example, just to replace maturing debt. And these auctions are getting bigger. Here's how the refinancing trap works. You borrow $1 trillion at 1% interest. It costs you $10 billion annually. 5 years later, that debt matures. You need to roll it over. Borrow another trillion to pay back the first. But now rates are 5%. Suddenly the same $1 trillion costs you $50 billion annually, a 400% increase in interest expenses. You haven't borrowed a single extra dollar, but your interest costs have exploded. Now multiply that by $9 trillion maturing in 2025. The Treasury tried to term out the debt, issue longer-dated bonds to lock in low rates. They succeeded in extending the weighted average maturity to 72 months. But it wasn't enough. More than 55% of the 2025 maturities fall due before July. By year-end 2025, an estimated $5 to $6.5 trillion had already been refinanced. That leaves $2.5 to $4 trillion still to roll over, and that's before addressing the 2026 maturity wall. Traditionally, foreign buyers absorbed much of this debt. But something changed in 2024. Japan, the largest foreign holder at $1.06 trillion, sold a record $61.9 billion in the third quarter of 2024. China, at $759 billion, offloaded $51.3 billion in the same period. Through 9 months of 2024, China reduced holdings in all but 3 months. By April 2025, Japanese investors were net selling $227 billion in long-term treasuries. Why? Because Japanese government bond yields rose above 2.5% for 30-year bonds and above 1% for 10-year bonds. Japanese insurers and pension funds are repatriating capital, buying domestic bonds instead of US debt. Total foreign holdings dropped from $8.68 trillion in September 2024 to $8.51 trillion by year-end. With foreign buyers pulling back, who fills the gap? Primary dealers, the banks and financial institutions obligated to buy treasuries, but they're already stretched. By early 2025, primary dealers held $364 billion in unrealized bond losses. Higher yields mean falling bond prices. They're taking losses on existing positions while being forced to buy more. And when primary dealers pull back, yields rise further, making the debt even more expensive to refinance. It's a doom loop. There's a formula that determines whether a country's debt is sustainable. The change in debt to GDP ratio equals the difference between the real interest rate on government debt and real GDP growth multiplied by existing debt plus the primary deficit. When the interest rate exceeds the growth rate, the first term becomes positive and multiplies against your existing debt stock. The higher your debt, the faster it accelerates. This is the wall. From 2009 to 2022, the US lived in an economic fantasy land where GDP growth exceeded borrowing costs. Paul Krugman described it as debt that melts away. Borrow at 1%, grow at 2%, and inflation does the rest. The debt-to-GDP ratio could stay stable or even decline despite running deficits. But that era is over. Today's numbers tell a different story. The US average interest rate on debt is 3.27%, and rising to 3.75 to 5.25% on new issuance. US GDP growth projection for 2026 sits at 1.4 to 1.8% according to the Congressional Budget Office and IMF. Unemployment is rising to 4.4 to 4.5% by 2026. Inflation remains elevated through 2026 due to tariffs and fiscal expansion. The 10-year Treasury yield hovers between 4.0 and 4.5%, down from the 4.8% peak, but well above 2021 lows. Assume a 3.5% average borrowing cost and 1.6% real GDP growth. That's a 1.9% differential. Multiply by the current debt level of 100% of GDP, and you get 1.9 percentage points of GDP added to debt annually, just from the interest growth differential. That's $570 billion in automatic debt growth every year before considering the primary deficit. Now add the primary deficit, government spending minus revenue, excluding interest. The CBO projects deficits averaging 5 to 6% of GDP annually. Combined effect, debt rising by 7 to 8% of GDP per year. At that rate, debt hits 120% of GDP by 2030 and 156% by 2055 under the CBO's baseline. But that assumes stable interest rates and steady growth. If either assumption breaks, the trajectory gets worse, fast. Interest payments are now the fastest growing category in the federal budget. Fiscal year 2021, $352 billion. Fiscal year 2024, $881 billion. Fiscal year 2025, $970 billion. Fiscal year 2026, $1.0 trillion projected. Fiscal year 2035, $1.8 trillion projected. As a share of GDP, interest cost hit 3.2% in 2026, exceeding the previous post-World War II record of 3.1% in 1991. By 2034, interest reaches 4.1% of GDP. By 2055, 5.4% of GDP, consuming 28% of all federal revenues. Economist research identifies the danger zone. When interest costs exceed 3 to 4% of GDP with debt, above 100% of GDP and interest rates above growth rates, you enter the fiscal fatigue zone. The primary surplus needed to stabilize debt becomes politically impossible. The US is already there. Higher debt leads to higher interest costs, which lead to larger deficits, which lead to even higher debt. Markets demand higher yields. Higher interest costs follow. Repeat. There's no way around it, only through it. By mid-2026, 4 critical pressures converge simultaneously. First, the maturity tsunami, $7.6 trillion in debt coming due in 2026 alone, following $9.2 trillion in 2025, over $16 trillion in total refinancing across 2 years. This exceeds the entire US GDP in 2019. Second, the debt ceiling crisis. The debt limit was reinstated at $36.1 trillion on January 1st, 2025. The House budget plan increases the limit by $4 trillion to $40.1 trillion. But the CBO estimates this new limit will be reached by November 2026, just 21 months after passage. The Treasury will need to use extraordinary measures to avoid default. Political gridlock over tax cut extension and spending cuts creates uncertainty. Markets hate uncertainty. Yields rise on political risk premium. Third, the growth slowdown. US GDP growth is projected to decelerate from 2.8% in 2024 to 1.4 to 1.8% in 2025 through 2026. The IMF downgraded its 2026 forecast by 0.4 percentage points to 1.7% due to greater policy uncertainty, trade tensions, and softer demand momentum. Unemployment is rising from 4.2% to 4.4 to 4.5%. Tariffs are adding 0.3 to 0.5% to inflation, forcing the Fed to keep rates higher longer. Slower growth means lower tax revenues, widening deficits further. The CBO projects revenue growth insufficient to match spending increases. Fourth, the foreign exodus. Foreign holdings declined from $8.68 trillion in September 2024 to $8.51 trillion by December 2024. Japan reduced long-term Treasury holdings by $227 billion as of April 2025. China sits below $800 billion for the first time since 2010, down from a $1.3 trillion peak in 2013. The UK, Canada, and Euro area are increasing holdings, but not enough to offset Asia exits. Net result: higher yields needed to attract domestic buyers. These 4 pressures aren't isolated events. They're synchronized. First quarter 2026. Economic growth slows as the Fed maintains higher rates. Tariff effects drag on GDP. Second quarter 2026. Massive refinancing operations as over $4 trillion in debt comes due. Debt ceiling politics intensify. Third quarter 2026. The debt limit crisis approaches. Treasury may need extraordinary measures. Yields spike on political uncertainty. Fourth quarter 2026. The $1 trillion plus interest payment milestone is confirmed. Markets begin pricing in fiscal crisis risk. Bond markets are forward-looking. They don't wait for disasters. They price them in advance. By mid-2026, sophisticated investors will have done the math. 16 trillion refinanced in 2 years at 4 to 5% yields. Interest costs jumping from $881 billion in 2024 to over $1 trillion in 2026. Debt to GDP approaching 107%, the historical tipping point. Growth slowing while borrowing costs rise. No credible plan for fiscal consolidation. The question markets will ask, if the US government can't stabilize debt with full employment and moderate growth, how will it stabilize debt during the next recession? That's when the risk premium starts to rise, when flight to safety becomes flight from US debt, when Treasury yields don't fall during crises, they rise. 2026 isn't when the debt becomes unsustainable, it's when markets realize it already is. The Congressional Budget Office doesn't use words like unsustainable lightly, but their April 2025 fiscal monitor contains a stark warning. In a severely adverse scenario, global public debt could reach 117% of GDP by 2027, nearly 20 percentage points above baseline projections. For the US specifically, debt held by the public is projected to reach 118% of GDP by 2035 under current law. But here's what that projection assumes. No major recessions, no financial crises, no wars requiring emergency spending, no significant policy changes beyond current law, and stable interest rates declining to 3.8% by 2031. What are the odds all those assumptions hold for the next decade? The Penn-Wharton budget model, using rigorous economic modeling, calculates that even under myopic expectations where investors believe the government will eventually fix the problem, financial markets cannot sustain more than 20 years of accumulated deficits under current US fiscal policy. That means by 2044 to 2045, it's over. But that's the optimistic case. With forward-looking, markets that doubt government commitment to fiscal reform, the unravelling happens much sooner. The model identifies 106% of GDP as the flipping point, the level where debt dynamics become irreversible without drastic intervention. The US crosses that threshold in 2029, just 4 years away. With a maximum primary surplus of 5% of GDP, the upper bound of what's politically feasible, the fiscal limit sits at 222% of GDP in low-risk states and 144% in high-risk states. At 100% of GDP today, headed to 107% by 2029 and 118% by 2035, the US is approaching the danger zone far faster than commonly understood. Once in the spiral, the feedback loops become self-reinforcing. High debt forces larger deficits due to interest costs. Larger deficits require more borrowing. More borrowing pushes yields higher through supply and demand. Higher yields increase interest costs on new and refinanced debt. Higher interest costs force even larger deficits. Back to step 2. This spiral has an endpoint. When annual interest costs exceed annual GDP growth in dollar terms, debt becomes infinite. You're borrowing money just to pay interest on previous borrowing, and the gap grows exponentially. Only 3 developed economies have ever exceeded 200% debt to GDP and avoided default or restructuring. Japan, currently at 230%, but offset by a 30% plus household savings rate and ownership of 90% plus of its own debt. Post-World War II US at 106%, but followed by 4 to 5% annual GDP growth for 2 decades, plus financial repression. Post-Napoleonic UK, but followed by a century of being the global reserve currency with no competitors. The US today has a household savings rate of 3 to 4% versus Japan's 30% plus. GDP growth of 1.4 to 1.8% versus post-World War II 4 to 5%. Foreign ownership at 29% of debt versus Japan's under 10%. And rising competitors for reserve currency status in the yen and euro. The conditions that allowed high debt in the past don't exist today.